Hey everyone, you know that humble copier sitting in the corner of your office? It seems pretty simple, right? Well, when it comes to your company's books here in Malaysia, it's actually one of the most surprisingly complicated items you'll ever have to deal with. So today, we're going to untangle all of that complexity and show you how to turn it into a real strategic advantage.
So let's just start with the biggest question, the one that trips up so many business owners. When you buy a copier, is it a one-time expense you just write off, or is it a long-term asset that you own? You'd think it would be a straightforward answer.
But it isn't. In Malaysia, the rules actually force you to treat it as both, but in two totally separate worlds. For the very same machine, you have to follow one set of rules for your financial accounts and a completely different set for your taxes.
So here's how we're going to make sense of all this. First, we'll look at this whole two-rulebook system. Then we'll break down how it works for your books versus your taxes. We'll even tackle the new curveball of leasing. And finally, we'll give you a playbook to become a true asset pro.
Okay, let's dive into the core of the problem. I want you to imagine you have to keep two different sets of records for the exact same piece of equipment. Well, here in Malaysia, that's not your imagination. It's just the reality of managing your assets.
And this is where those two rule books come into play. See, on one hand, you have your financial books. These are governed by the Malaysian Financial Reporting Standards, or MFRS. This is for your investors, your banks. It's all about showing the true financial health of your business. But on the other hand, you've got your tax return. This is governed by the Income Tax Act, which is what LHDN, Malaysia's tax authority, uses to figure out how much tax you owe. Two different audiences, two totally different goals.
So here it is, the most crucial point of all. The gradual expense you record in your financial books as the copier gets older, that's called depreciation, is completely 100% ignored by the taxman. You cannot use that number to lower your taxes. That's the one rule you have to remember.
Okay, so let's break down that first rule book. How your accountant has to treat that copier for your company's official financial statements.
First off, you don't just expense the copier. You capitalize it. Now, that's just a fancy way of saying that if it's going to provide value for more than 1 year, and most copiers do, you have to list it as a long-term asset on your balance sheet. Most companies will set a threshold for this, something like 1,000 ringgit, just to make it easier. And the cost of that asset? It's not just the price on the invoice. Oh no. It includes every single thing you spend to get that machine up and running. Delivery, installation, maybe even some special electrical work you had to get done. All of that gets bundled into the initial value of the asset.
Then year after year, you record something called a depreciation expense. This is simply the accounting way of showing that the asset is being used up, that it's slowly losing its value over its estimated useful life. Okay, let's switch gears and jump to that second rule book. I want you to forget everything about depreciation, because when it comes to your taxes, the rules offer something way more beneficial for your cash flow. We're talking direct tax relief.
The tax system gives you what's called a capital allowance. You can just think of it as the government's special tax deduction for businesses that invest in assets like office equipment. It's really designed to help you recover the cost and, encourage more investment.
And it's very generous right up front. In the very first year you own and use the copier, LHDN lets you deduct 20% of its cost, straight off your taxable income. This is called the initial allowance. And it doesn't stop there. On top of that initial 20%, you also get to deduct another 10% of the original cost every single year. This gives you a really significant and predictable tax break, all spread out over the life of the asset. Let's put some real numbers to this. Let's say your new copier system costs 10,000 ringgit. In year 1, you get a 2,000 ringgit initial allowance plus a 1,000 ringgit annual allowance. That is a grand total of 3,000 ringgit that you can deduct from your taxable profits. That's a real immediate cash flow benefit for your business.
Now, a lot of businesses try to avoid all of this by just renting or leasing their copiers. And for years, that was the simple option. But a recent accounting standard called MFRS 16 has thrown a major wrench in the works.
So you might be sitting there thinking, okay, I'll just lease my copier and skip this whole asset and depreciation headache. It makes sense, right? Well, not anymore.
The way we have to account for leases has completely changed. It used to be so simple. A lease was just a monthly rental expense, kept neatly off your balance sheet. But under these new MFRS 16 rules, that same lease now forces you to add both an asset and a liability to your books. This is a huge deal because it can directly affect your company's debt ratios and even its ability to get a loan.
So here's how it works. The lease creates what's called a right-of-use asset.
That's basically your right to use the copier for the lease term. At the exact same time, it creates a lease liability, which is the debt you owe for all those future rental payments. And yep, you then have to depreciate that right-of-use asset in your books. So leasing no longer keeps things simple.
So, with all these different rules, how do you stay compliant and actually turn this knowledge into a real financial advantage for your company? Let's build your strategic playbook.
The single most powerful tool you can have is a fixed asset register. This is not just some boring list for your accountant, it's your command center. It makes sure you have a crystal clear audit trail for LHDN, but more importantly, it helps you make smart business decisions about when it's time to repair, replace, or invest in new equipment.
All right, here is your playbook. First, time your purchases strategically. Buying a new asset in a really profitable year can seriously lower your tax bill. Second, and this is a pro tip, you gotta know that certain assets get special treatment. Things like ICT equipment, computers, software can qualify for even faster allowances, sometimes up to 40% in the first year. That's a massive deduction. Third, before you sign any lease, analyze its impact on your balance sheet so there are no surprises. And finally, the golden rule. Always, always maintain separate, clear calculations for your accounting depreciation and your tax capital allowances. They live in different worlds.
So, that humble office copier turns out to be a pretty powerful tool, not just for your office, but for your entire financial strategy. So we'll leave you with this to think about. Now that you understand Malaysia's 2 rulebooks, is your company's asset strategy just another expense line, or are you actively managing it as the tax goldmine it can be?